I was left in winter. I was born in a blizzard and like, I literally love the cold. I was,
Okay. Uh, So there's a level of trust there, between us. And I went with him because I used to have my money with, somebody who just said, do this and didn't tell me why. There was no education component and there wasn't any real give and take about what was important to me and what my goals were. It was just like, give me your money, we'll get you there. And, so I think it's important for people in our industry especially who find ourselves with our nose to the grindstone and just always on the treadmill, that we forget to pay ourselves and put back for our future. Hey, Michael Gross. So,
Come on up front.
and thank you. And thank you for lunch.
My pleasure. Let's make it awkward.
More awkward.
So I appreciate it. Guys, I like this to be very casual. If you guys have questions throughout this, if you want to stop me for any reason, feel free. If you have specific questions that we didn't cover, let me know. But like you said, my name's Nate Keller. To kind of introduce myself, I've been doing this for about 11 years, the financial side of things. And my backstory is probably about 13 years ago or so. And I'm on Zoom too, correct? Okay, so I'm talking to a lot more people because I want to address them too. But about 14 years ago, I had a conversation with my wife about doing better financially. We made good money. I worked in corporate America. She had a full-time job. And we paid our bills. We weren't hurting, but we had debt. We weren't really saving anything. I had no clue where I stood for retirement. So I started reading books, listening to podcasts, getting as much info as I could on money and investing and things like that. And I found out very quickly two things. I never learned it in school, and my parents never taught it to me. So we started implementing it. We paid off all of our debt in 2 years. We saved a big emergency fund, got on track to retire early if we wanted to. And I said to my wife, I would teach this to people for free. I was already talking to my friends, my siblings about it. And so I was in a corporate job. I won't go into the details of how that relationship kind of went south. So I left and started my own firm, and I get to teach people exactly what we did to be financially successful. So I do a lot of education. It's evolved. My business has kind of evolved 4 ways. Number one, it's very educational. That's how I learned. I know that the education is lacking, so I like to teach these things. I usually do about 2 to 3 of these a month. I do them for small businesses predominantly. But this is the second one I've done here. I did kind of a smaller one recently for you guys too. But I just like to teach the fundamentals that I learned to be financially successful. So we're going to go through this booklet. So if some of you were here before, I'm sure some of you were not. I'm actually going a little bit different direction. We're going to talk more about the investing side and building wealth than the entire picture. When I was here last time, we talked about getting out of debt and all kinds of other stuff. We can cover all of that if you would like to, but for the sake of this booklet, it's going to talk more about building wealth investing. For the people on Zoom, we just updated this book. These are the old version. The PDF that you're probably looking at is the new version. So numbers and dates might be slightly different, but all the concepts are the same. And the pages are almost identical. So you don't really need to worry too much about that. But just out of curiosity, how many of you are psyched when it comes to finance? You like finance, you kind of nerd out on it. Anybody in here? No? Okay, I'm the only one. Awesome. So I found that finance tends to be an adult chore. Most people don't want to deal with it. Another way that my business has evolved is I take a very, very heavy focus and a foundational view of generosity in my business. When I meet with someone, I want them to have, I want to help them get to where they have more than enough resources to fulfill their goals and purpose, but also the ability to give money away. If we're talking about generosity, we're going to hit all the milestones along the way of getting out of debt, saving and investing, all that stuff. So it makes the conversation easier. But one other thing that's happened over the years I've been in the business is the investment world has kind of become my niche. I'm very much a nerd when it comes to the market. I enjoy that sort of stuff. How many are comfortable with the market and investing? All right, we go.
Not by myself.
Yeah, right. Okay. Yeah, I appreciate that. But so that's one reason that I stay as busy as I do, because most people don't have the time anymore. We're in a market right now that moves extremely fast. If you look historically, a lot of stocks are traded through algorithms and AI at this point. So if you ever watch, does anybody watch the market on a daily basis or check it out? Occasionally you'll see like a 3% drop in a day, a 5% drop in a day. A couple of months ago, we had a 10% drop over 2 days. That's extremely fast. That didn't happen much at all in the past. And the reason is because these programs see certain stuff and they either buy or sell and the market jumps either way. However, the fundamentals stay the same. So I'm going to walk you guys through a couple of those. If you start on basically on the inside in the first page, you guys being in real estate, one thing that I've found, and I have a lot of real estate clients for the simple fact that just getting referred to them because you guys have more options when it comes to investment accounts and retirement accounts than the average worker does. So like, how many are familiar with the SEP IRA? How about a solo 401k? So those are two options that most realtors take advantage of because they're very, very beneficial. One of the biggest benefits to them is that you can put a lot of money away and write it off on your taxes. So if you drop a big lump sum, if you want to put money in a Roth IRA or traditional IRA, you can only do $7,000 per year. If you're age 50 or older, you can do $8,000 per year, but that's what you're capped at. And if you're making really good money, they actually cut you off and you can't contribute at all. So as a household, if you make 230, 240 and above, you cannot put money into a Roth IRA. They cut you off. So a SEP IRA, there is no income limits, and you can put in 25% of compensation or 70,000, whichever is less per year. So you can put a big chunk in. 401k, solo 401ks, depending on how you run your accounting, how your CPA files your taxes, you can actually do more than a SEP IRA because you can contribute as the employee and as the employer, even though you're both. So those are a couple of things, and I can answer questions on those, but they're more of an independent, specific one-on-one conversation of what makes the most sense. But I can answer questions on those. But if you guys look at the next page here at the very bottom, it just basically lays out the investment phases from now to basically for the rest of your life. So you have accumulation phase, which is when most people are building assets, generally between now and age 55, roughly, depending on when you want to retire. You have the protection phase, which is close to retirement. We still want to grow, but we don't want to take a massive hit if we can help it. And then we have the distribution phase. Our assets need to create money, create income for us when we're no longer working. Again, you guys are somewhat unique because most of my real estate agents that are now retired are not retired from real estate. They might not do as much, but they just sell a house when someone needs to sell a house. They make money. They're just not actively out doing all the things that they normally would do. But we want to focus on investing properly in all those areas. One area that I tend to be different is I'm growth oriented almost exclusively. I don't recommend getting overly conservative in retirement. I'll just say, I don't know, 10, 20, 30, 40 plus years ago, financial advisors, it was a little bit different. Most people worked to mid 60s and life expectancy was early 70s. So you're looking at 10 years of retirement, maybe 15 on the long end. Now, most people are going to live 15, 20 years plus in retirement. Or if it's a husband and wife, if they both make it to 65, there's a very good chance at least one's living to 90. So we're going to have to create 20 plus years of income. So if we start getting conservative in retirement, we might run out of money. I have a little piece I didn't bring along that I just show the historical growth of inflation or cost of living rising. I don't know how many of you guys I probably wouldn't know these numbers, but in 2002, the Big Mac was $2 for the sandwich, $2 and change. In 2012, it was $4 and change. 2022, it was $6 and change. And right now, it's actually hovered around $6 still up to right now. So it's tripled in price in 20 years. So cost of living will double or triple roughly in that area in a 20-year period. So if you're living in retirement, what you started with, you're going to need double that towards the end, more than likely, or somewhere near it. But I flipped the page over and it has McDonald's stock. McDonald's stock in 2016 was $16 a share. In 2022, it was $267 a share. And it went from a 24-cent dividend per share to a $6 dividend per share to own their stock. So if cost of living is rising and people are buying Big Macs and paying more for them, I want to own McDonald's stock because that just bridges the gap for me and I make more money because I own their stock. I like to stay more growth oriented even in retirement, even though we have to figure out a distribution plan. If you guys flip to the next page, how many people in here, if you haven't been to one of my workshops, how many have heard of the rule of 72? No one? All right, awesome. It's usually the case. I usually don't get any hands. I wish they taught this in school. The rule of 72 is very simple. It shows how compound interest works. If you're earning interest or some sort of rate of return on stocks, on mutual funds, on a savings account at the bank, If you take that interest rate, divide 72 by that interest rate, it's how many years it will take your money to double. So you can see here, if you're earning 3%, you're gonna double every 24 years. 6% will double every 12, 12 every 6, so on and so forth. This is very important because I run into people all the time that are saving diligently, but they're getting a poor rate of return. I just met with a client last week, $400,000 sitting in the bank earning 0.05%. We can move it to a money market and make 4 just like that. So let's just say we put $10,000 away, we're earning 3%, we're doubling every 24 years. How many more 24-year doubling cycles do you have in your life? I'm 43. I got 2 if I'm lucky. I have never met the person, you can see here, 10 grand invested at 3%, 48 years is 40 grand, at 12% in 48 years, it's 2.5 million. I've never met the person who wants 40 grand over 2.5 million. It's just rate of return is very important. How do I get there? So I won't go into detail on these unless you guys want me to, but I have 5 specific fundamentals of investing. Number 1 is a disciplined strategy. What is your strategy? Is it to create income? Is it growth? Is it long-term? Is it short-term? We need to make sure we have a strategy and we're very disciplined to it. My job comes in on the discipline side. I remove the emotion. Don't panic when the market's ugly. Don't get greedy when the market's good. I think it was February when that trading day, the 2 trading days I talked about where the market went down 10%. A lot of people were panicking. I didn't really get many calls from clients, but when I was getting referrals, they were coming to me because they were panicked. A lot of people were pulling their money out. Literally a week and a half later, Trump put a stay on all of the tariffs and the market went up 10% in one day. So anybody who jumped ship after the 10% downfall missed the rebound of 10%. So staying the course is very important. Second thing is diversification. We'll talk about that here in a little bit. Don't put all your eggs in one basket. Number 3 is dollar cost average. Anyone ever heard that term? So dollar cost average is just, I call it systematic investing. But if you're systematically investing, every time the market falls, you are what's called dollar cost averaging into the investment. You're buying more shares for less money. Any bargain shoppers in the room? Find good deals. My wife is a good one. So the stock market is the one place on earth that people will not buy things on sale. They'll buy cars, clothes, food, everything on sale. But when stocks go on sale, they run for the exits. I will buy. So dollar cost averaging does it automatically because we don't know when the market's going to rise and fall on a day-to-day basis. But if we're consistently putting money away every week or every month, we will buy through every single dip. Number 4 is domestic focus. I just personally like to bet on the USA. I don't like to invest in international stocks. They've underperformed for the past 30 to 50 years. And I don't want to exchange currency. I don't want to pay taxes that I don't know about, wars, governments, all that sort of stuff. So I focus on the US. And then last but not least is dividend reinvestment. Just like the McDonald's stock, I want to own stock that pays me to be invested. I tell all of my clients, dividend paying stocks are like rental houses. You own the asset, you get a paycheck every single month or quarter or whatever, and it doesn't matter what the value of that home does, you're getting paid. I have yet to find the person who, so stocks, it's funny, when stocks fall, they want to sell. But if we have dividend paying stocks, I tell them, well, let me ask you a question. If you bought a rental house for 100 grand, you were getting $1,000 a month in rent, and the market dipped and now it was worth 80, would you panic and sell the house quick when you're getting $1,000 a month in rent? They're like, no way. I'm like, stocks are the same way. Don't sell them, just keep the asset. It'll grow over time. So again, I talked about rate of return is key. One side note, one of the biggest issues in our culture is debt. If you're in debt, this rule of 72 is working against you. It's working for somebody else. So the day I paid off my last student loan was one of the coolest financial days of my life. I was sitting down doing the budget and the bills that month. I had a really good month, and we owed, I think, $7,000 and some odd dollars, and we had like $18,000 in savings at that point in the account because we had a good month. And I said to my wife, any gut feeling that I should just pay this off today? Wrote the check, was done. Haven't had any debt since, and it's been like 12 years since that time. So, but debt is an issue. I want to get someone out of debt as quickly as possible because we can get that money working for them instead of paying it to somebody else. Up at the top here, this is just a quick example of why investing and being growth oriented is more important. This shows the S&P 500. Now in our book on those of you on Zoom, it's a different time frame, but it's very, very similar. This is just showing basically a 30-year period from 91 to 2021. The S&P 500 has averaged 10.64% over that time annually. So some years it's up, some years it's down, but annually, if we drew a straight line, it averaged over 10.5%. If we were in bonds, it's 5.25 roughly. If we were in US bonds, it's 2.25, and US inflation was about 2.3%. Now, that number is way different more recently. If we cut that off at 2021, that makes a big difference to the inflation we had more recently. But I would much rather get 10%. If I'm gonna invest long term, that's the biggest key here. I'm talking long term. If you came to me and said, hey, I want to invest over the next year, we're gonna have a completely different conversation. This is long-term investing. At the very bottom, another example of discipline and staying invested is over since 1937 to 2021, they took different periods, a 1-year period, a 5-year period, a 10-year period, or a 20-year, a bunch of them all, and said, how many years was the market up? How many was the market down? All the way over here to the right, you can see that money in the market just stayed the course. So again, staying invested. If you back up and go to the 10-year, there was only 2 times ride for times, by the way, was coming out of the Great Depression and the dot-com bubble of 2000. They call it the lost decade, from 2000 to 2010 with Y2K and the tech bubble burst. If you guys, I don't know how many of you remember that, you would have basically been break even over a 10-year period if you would have put money in and then pulled it out 10 years later. But if you're doing long term, you have a very, very, very small chance of losing money if you stay the course. Any questions on any of that? And you can slow me down. I tend to talk fast, so if I need to slow down, let me know. So if you flip to the next page on the right-hand side, this is just illustrating dollar cost averaging that I talked about earlier. So it shows 2 investors. Investor A, you can see at the very top, the market climbed the whole time they were investing. It never dipped, just went straight up. And if you talked to 100 people and said, would you rather the market climb every day or the market's choppy, up and down, up and down, up and down? Almost everybody would tell you they would rather the market grow, but you actually will make more money if the market chops. Warren Buffett owns a ton of stock in Coke. They pay a good dividend. If the market goes down, he does not give a crap because his dividend buys him more shares. And when the market gets back just to break even, he's made more money because he's accumulated more shares through dividends. So the first, both investors here were putting away $100 a month. You can see investor A, the market just continued to climb. Investor B, the market dipped and then rebounded back to break even. That's it. So over that 6-month period, if the market did that, investor A would have accumulated 42 shares and the stock price would have went from $10 a share to 20 a share. So if you do some quick math there, 42 shares at $20 a share is $840 in their account. Investor B, it started at 10, dipped to 2 and back to 10. Over that period of time, they were still putting the same 100 away. They accumulated 126 shares because they went on sale. And at $10 a share, they have $1,260 in their account rather than $840. And the stock price is lower. So putting money away every single month will create more wealth long term. Any questions on that? Good? All right, I must be doing a good job. So the next page, this is just an example. I like this page because it shows the history of the market from 92 to 2021. And it just shows something every year that could have been cause for concern for the market to drop and a reason to get your money out and a reason to panic. But the market, if we look at point A to point B, it obviously grew. And you can actually see there, if you look across from 2000 to 2010, you can see that lost decade. If you look at the graph, there's not a whole lot of upward momentum, a small spike, but it pretty much was level from for that 10-year period. But this doesn't even show more recent markets that have done very well. 2022 was a very rough year. You can actually see it on the tail end of 2021. It started to dip and 2022 was rough. But another thing to keep in mind, probably the best example of why staying the course is important. We all remember COVID. Does anybody remember in February of 2020 is when they started shutting stuff down? There was a lot of panic. The market dove and hit rock bottom on March 20 something. But it went down 30+% in 30 days. It's the fastest the market has ever dropped. People were panicking and running for the exits everywhere. I was actually calling a lot of my clients and saying, if you've got money, put it in now, because this is super cheap. Everything is telling me the market should grow. Anybody who put money in March of 2020, by the end of the year, if they just put it in growth oriented stocks, we're up somewhere in the neighborhood of 50 to 75% on that money in less than one year. So that is a great example where you can see the market went up in 2020. We don't even see the COVID dip if we just look at it on an annual basis, because it rebounded so fast that the market was only down for a short period of time, literally only a few months. So it's very, very important to stay invested. Flipping to the next page. Diversification is extremely important. And I just like to show this page for the simple fact of, if you guys were going in and placing your bets year to year of what's going to perform the best, how good do you think you'd be? Each different category of the market is depicted by a different color. So how accurate do you think you guys could be? And I'll admit, I have no idea. I do this for a living, and I could not tell you what's going to perform the best. But if I have equal representation in all areas, I'm going to make money long term, and I'm going to reduce my risk. So this is just showing that international stocks performed the best in 2007, government bonds in 2008, and international stocks again in 2009. And then international stocks were never the best performer again until 2017. So we have no idea what's going to perform the best. If you ever run into someone who tells you this is a sure bet, you need to do this, I'd run the other way, because us professionals have no idea what's going to perform the best. We just need to fundamentally invest and get at all areas of the market. Small companies, mid-sized companies, tech, financials, real estate, all that stuff. So any questions so far? Good? Okay. This next page, if you flip to the, I don't think it has page numbers, so I can't give you a page number, but it has this, this big chart here. So this is outdated and says 6,000. Now you can do 7,000 to a Roth. So the PDF for those on Zoom probably say 7,000. But this is just again showing the example of two different investors. One that started early, you can see at age 22, started fully funding their Roth. At age 29, for whatever reason, they stopped. They only did it for a few years and then stopped. Let it ride all the way to retirement. They let it grow at an average rate of return of about 9%, which is very doable. They had $2.2 million at age 67. They only invested $48,000. Investor B did not start early. They waited till 30 and decided to fully fund it to catch up all the way out. So they invested $228,000 over that time, and their account was only worth $2 million. So the sooner you start, the better. Now, I always ask the question, which investor would you rather be, A or B? The trick question. I'll say both. Fund your Roth or fund your accounts and do it all the way to retirement. If one of these individuals would have started at 22, did it all the way out, we had them both up there for $4 million in tax-free retirement accounts. Pay zero taxes in retirement on any of their income. So I recommend being both, but it pays to start investing early. One side note that I will mention, I find a lot of advisors will only advise on the stock market and they only push people to the stock market. I'm talking a lot about it, but I think there's 3 ways to build wealth. If you look at anyone successful in the entire country, there's 3 ways that they built wealth. It was the stock market, it was real estate, or it was a business. And I like a combination of all 3 if someone's willing to do it. Own some real estate, own stocks, have a business, or even a side business that creates income, multiple streams of income. One of the reasons I say that is I have clients that were on both ends of the spectrum. They had no real estate. We started working together. They had extra money rather than putting it in the market. They ended up buying rental real estate. I had clients that came here that all they had was real estate. One in particular, younger guy, I think he's mid-40s maybe at this point. But when we met, he owned a trailer park and all in total, we had like 125 doors as far as his real estate portfolio was concerned. The one issue that we've run into with that was COVID. I hope it never happens again, but we had some clients that their rental income stopped or reduced because people stopped paying rent, moratorium on evictions. All of a sudden they're like, this is my income, what am I going to do? And then at that point, they're starting to look at selling houses when they probably don't want to sell houses. So for all of those clients, I just recommend they open up an IRA or something and start socking some of the money, and the rentals a lot of times pay for it. Start putting money away into investments. Because if we got IRAs over here, your renter leaves, we can pull from the IRA until you get a new renter in. And so there's diversification in that regard as well, not just in the market. So last couple of things I'll go over. I guess this is the last page. Looks like there's a piggy bank at the top. There's 3 different types of accounts I recommend that you focus on long-term, when it comes to saving. You have an emergency account, you have a short-term account, you have your wealth building. Wealth building being your IRAs, long-term retirement savings. That's where your money is gonna work the hardest for you. It's out of sight, out of mind. You're not gonna access it readily. It's not liquid. You'll pay taxes and penalty if you pull it out prior to 59 and a half. But this money should work the hardest for you. The emergency account on the other end is very liquid. You can access it anytime you want, a savings in the bank, a money market. But the downside, it's not really gonna make you much, if anything at all. But it's designed to prevent you from having to take out debt if an emergency happens. The best example I have of this, my son is 6. When my wife was 8 months pregnant, one evening I was going to bed, and if you guys have been in my seminar, I tell this story all the time. I was just laying in bed. She was in the master bathroom. She's like, Nate, there's a pile of dirt on the sill in here. And so we have like wainscoting around. There's this little pile of dirt. I walk in, you guys have seen those excavating ants that like out along the sidewalk. It looked just like that. So I'm like, that looks like ants. So I start looking around, and up in the corner, the drywall was bubbled a little bit. I was like, that looks a little wet. So I reached up and I actually touched it. It cracked and all these ants started falling out. So she's freaking out. I run out into the garage and get the one can of Raid that I know where it was. I have other stuff in the shed and everything. And I come in and it had just enough to like put a little puff, and that was it. And it was empty. So luckily we live near a Giant. So I hopped in the car, ran to Giant, got a bunch of stuff, came back, took care of the ants. Long story short, we found moisture in the wall, which realized there was mold. I had to cut like a 3 by 4 foot section of drywall out, pull it out. It was moldy. Unfortunately, it was only that. But the person who put the roof on for the buyer previous to us did the valley incorrectly on the addition. And around, there's a vent pipe right next to the valley. So the vent pipe and the valley were both leaking into the wall. The moisture attracted the ants, and that's what got us to it. So I had to replace the entire roof because to repair the valley, it might as well. In addition to getting rid of the mold and all that stuff, I cut a check for over $10,000 a month before my son was born, but I had an emergency fund. I literally just paid cash for it. Otherwise, I would have done a home equity line, I would have personal loan, a credit card. I would have to do something because my son is coming home in a month and I don't want mold and a leaky roof and all that sort of stuff. So an emergency fund is extremely important. Someone like me, it annoys me all the time because I don't make much money on it, but it's there to prevent me from having to pay debt to somebody else and pay interest to someone else. The short-term account is just basically if you're on track for retirement, you got your emergency fund in place. Anything above and beyond that emergency fund that you need immediate access to, I recommend saving it, investing it somewhere where you're going to make a much better rate of return than the bank, where we can get 6, 7, 8, 9, 10%, but it's still accessible if you need it. This is great for saving for vacation homes, for a new home, for a down payment, for a wedding, for college, for anything like that that is not super long-term, but we want to make a good rate of return. We still need access to it. So one thing, and I forgot to mention this at the beginning, there's an interest form in there. I always like feedback on anything that we're teaching on. But if there's something personal that you wanted to talk about or you wanted to connect with me, you can fill that out. I will grab it before I leave. I also gave everybody, I think everyone got one, a calendar. They're 2025, so I'm trying to get rid of them before the year ends. But it has my nice mug on that. You can put on your refrigerator or whatever. But it has a bunch of recipes in it. So on the back side of each month are recipes and stuff. So that's just a little extra for you guys. But does anybody have any questions on anything from a financial perspective that I can answer at this point? And I will hang around a little bit.
Yeah, should Andrew and I be doing anything else?
I think you're good. As of right now, you're good. If that changes, you will get a phone call.
You guys can talk about that and hunting.
Yes. Yeah, I usually set aside a little bit of time when we chat because hunting is both of our passions. So
We appreciate you.
Thank
You were very helpful for us this year.
I appreciate the kind words. Always enjoy the conversation with you guys.
So I have a question.
Yeah.
That I should probably be embarrassed about, but and maybe it's more appropriate for the forum, but so I have worked in also the corporate world my whole life and have been doing this for a year now. And I actually have 3 401ks, or actually one's a 403b that I had at those jobs that are
Right.
all still just sitting there,
Right.
and I'm not putting money in them. And is there a quick answer? Just
I can give you kind of a general blanket answer. Yeah, it would make sense to sit down and look at exactly what you have. But 9 times out of 10, if you leave an employer, I call it a get out of jail free card. Because of ERISA laws and 401ks, 403bs, anything like that, you're limited to the fund options you have. just to what they have, and it's usually 15 to 25 funds, that's it. One mutual fund company that we could use, whether it be Invesco or Fidelity or Franklin Templeton, they'll have hundreds of funds, all different areas of the market. So if nothing else, we have more options moving into a private IRA. And if you have multiple, we would just combine them into one account, because then you're not paying an annual fee of $25 to $200 on 3 different accounts. You're just paying one $25 fee on one IRA. So that would be the short answer. 9 times out of 10, we end up just rolling it out. If it depends on what it is, I would say the 1 time out of 10 that we don't is because they either have stipulations on it or a period of time where you can't touch it, or maybe they have a better fund lineup and it doesn't make sense to move it at the moment. But 9 times out of 10, I recommend we move it.
Thank you.
So, yep. Any other questions I can answer?
Can you talk about, well, I know that being around real estate agents for a long time, everybody talks about, oh, I'll buy this, it's a write-off. I'll buy this, it's a write-off. And I think that having a retirement account where you can actually pay yourself
Mhm.
and get that write-off is a much better approach.
So
Can you explain how that works?
sure. So I would say 2 things. I would write off everything you can, obviously. Pay Uncle Sam as low as possible. I tell my CPA every year when I write my check, I was like, can I just go burn this cash in a field? Because it's pretty much the same as writing the check and giving it to Uncle Sam. I see it that way. I won't go down a political rabbit hole, but they're just going to waste the money. I don't want to pay any extra to Uncle Sam if we don't have to. But to your point, I can speak from experience because of having the business. I have a SEP IRA. I go on extension for my taxes every year. I'm going to pay Uncle Sam as late as possible. And I sort out everything. And if I have a good year this year, or I do better, or I can actually put money in my SEP all the way till October 15th, and he can tag it for 2024, and it'll reduce my taxes. And I will not pay nearly as much as Uncle Sam. So to your point, I tell a lot of my clients, if you're getting to the end of the year and you're talking to your CPA and they're like, hey, if you can go spend $5,000, we can get you this much savings. If you don't have something you need to spend it on, you are much better served just dropping it into your retirement, because you're not spending it. You're just dropping it in there and it's going to grow for you. You're actually paying yourself as opposed to paying someone else.
Rather than buying a new car,
Correct.
for the write-off.
Correct.
you Put money in a retirement
100%.
account.
If you don't have to spend the money, invest it. If there's stuff that you need, go get stuff that you need. I'll do that from time to time. I'll just look at supplies and say, okay, I can spend about $1,000 in supplies for the office and all this stuff, but then the other $9,000 to get to the 10,000 he said I should do. If I can do it, I'm dropping it into my SEP. So it's just going to grow for me from now to retirement. So 100%. So I think if you don't have a CPA doing your taxes, I highly, highly, highly recommend a tax professional as opposed to doing them on your own.
Can you recommend a CPA that you work closely with?
In this area, no. I could look around and find some of my contacts and see if there's anything in the York area. Yes, I have a couple in York that I can refer. That they are very good. Most of the CPAs I deal with are good in business, self-employed, and they do personal taxes as well. But on the self-employed side, the reason I say go CPA is it's always and forever going to be a moving target. Once you think you got it nailed down yourself, they're going to pass a law and they're going to change a write-off, or they're going to change. How many in here have heard of QBI when it comes to taxes? So QBI, most of them should be doing it, but QBI basically says that if you have self-employed income, once you deduct all your taxes or all your expenses, whatever your income is, you can immediately write off 20% of that. And I think with the big, beautiful bill, it bumped to 23. Don't hold me to that. It was supposed to, but I don't know if they moved that out. But 20% of that income after your expenses and everything is immediately written off, because, and most CPAs should have that in their software. It does it automatically. But if you're doing it yourself, depending on what forms you're doing or what software you're using, I would always go to a CPA to make sure, because that's a big deal. That's a huge tax saving. And most people don't even know about that. And the fact that if nothing else, the big, beautiful bill made it permanent. It was only part of the original Trump tax cuts, and it was supposed to go away at the end of this year, but they made it permanent. So it's either 20 or 23% that you immediately write off on your self-employed income after your deductions are taken off. That's It's a little more complicated than that, but that's the general rule of thumb. But the CPA will know all that stuff. And when I started my business, I went to the CPA and I said, no BS. I said, I want to be on this side of the law. But I said, take me right as close to the line as I can. Everything I can write off, I want a list. Give me everything I can write off, how I can write it off, when I can write it off. I said, I bought a boat and I'm like, can I wrap the boat and write that off? And he's like, well, you can't write off the boat, but you can write off the wrap if you put your logo on it and stuff. So I'm like, okay, I haven't done it yet, but I'm just looking for ways to, even in recreation, if I can write off stuff for recreation with clients and things like that, I'll do it. Cause I will pay as little to Uncle Sam as possible and stay on this side of the law. Cause I don't want them breathing down my neck.
Like if you have to travel,
Correct.
do education while you're traveling.
Yeah. Absolutely.
Take clients with you.
I mean, like,
Yeah.
No, clients that are friends that you sold a house with, yeah.
I have, yeah, and that's where a CPA, you sit down and say, okay, what is, and not only that, some stuff is fine, but it's a red flag to the IRS where you're gonna get audited. And I don't even want to deal with that. But I have an advisor that I partner with on a lot of stuff. He lives in Colorado. He said many a times, come out to the ranch, we'll hang out. I was talking to him in April. And when we had that real warm spell in April, I said, it got kind of warm here in April for you. And he pulls his window back and looks and says, I just got 6 inches of snow last night. So he always says about going out there. If I go out there, most the travel and everything I can write off because we do business stuff together. We're going to go out there. We'll do some training with his team. We'll do other stuff. I can write it all off because of being business oriented. I can do some pleasure while I'm out there, but it's a business trip. So. Any other questions I can answer from a financial perspective? Or anything really? Hunting? Or about hunting?
Oh, I got a question.
Sure.
As far as conversion, like retirement from the military and converting that TSP and all that funding over.
Yep.
Is that something that you're,
10 times out of 10, I do that.
okay,
The TSP has 5 funds. You're probably familiar with that.
Yeah.
The D, the F, the I, the S, and the G. That's it. That's the only 5 funds you have. So anytime I do that, so 2 reasons I do that. I do it because you only have 5 funds. And the other reason, I run into TSP with the Postal Service and federal workers and everything. It's all the same. I don't think this will ever happen, but again, I'm not a conspiracy theorist. I guess maybe I'm a little bit, but the government is running the TSP. I don't want my money in anything that the government has their hands
I
on
don't trust.
because they could end up changing it. I don't think they will. I don't think you'd want to take off all the military, but I just don't want their hands on it. They could change it. They could change how it gets invested. I mean, they could turn it around at some point and just say, well, we no longer have these funds. You're just going to earn this % on it every single year. They could do whatever they want with it. So 10 times out of 10, I shouldn't say that. There's probably some outliers out there, but in my career, every time I run into the TSP, we moved it out.
I just don't, I have no control, or that's at least what it feels like.
Yeah, you don't really. I mean, you have control over picking the 5 funds. That's it. And there's only one of those that I really think, 2 of them, I should say, that they're worth their salt. It's the C and the S fund. C is common stock. It's like the S&P 500. Basically, that's what it's almost identical. And the S is small companies. So it's just smaller, more newer growing companies. The I is international, F is fixed income and bonds, G is government bonds. So if you go that page in here, I forget what page it was. I think it was towards the beginning with the rule of 72. This right here. So your S and your C fund are pretty much like this top line. The F fund is the bonds. The G fund is the treasury bills. So if I were to pick, I'm going to pick the one that's going to make more. But we have a lot more options than a private IRA. Just roll it out through private IRA. Pretty simple. You go on their website, fill out a form, tell them where to send it. It's tax free, straight over there. No penalties, no taxes, right into whatever IRA you want to put it in. So, good question. Any other questions? Good. All right, guys.
This is great.
Yeah.
This alone, so much great information in it.
Thank you. Appreciate it. I can't take credit for putting it all together, but I just teach it. So I will hang around. If anybody has any questions, I'll be in the back. Feel free to grab me. I have business cards if you want my card as well. My information is all on the magnet that I handed out. So I will grab any of the interest forms as well while I'm here if you want to stop and drop them off. I appreciate your time. Thank you, guys.
Thank you.
Thank you.
Sir.